Sell in May, go away. It's the most repeated, most cliche saying in finance. The idea is simple. The stock market is essentially flat during the summer. So you should sell your portfolio on May 1st, sit on the beach in cash, and buy back in November. But as quantitative traders, we don't trade rhymes. We trade data. So I backtested the S&P 500 from 1990s to April 2016 and also included VIX, the 200-day moving average, volatility targeting, and regime filters. I wanted to see if the calendar is actually a viable trading signal or just some nonsense. The data revealed two things. First, the seasonality is absolutely real. But second, if you actually trade it blindly, you're going to destroy your portfolio's growth. Here's exactly what the math says and regime aware framework you should be instead using. When we break down the market by month, the sell in May crowd actually has a point. Look at the data. Historically, months like August and September are the absolute worst performers of the year, averaging negative returns. Conversely, November through April captures massive historical tailwinds. But here's where the story gets nuanced. May itself is not actually a bad month. July was also strong, October was strong too. The weakest months were mainly August and September. So the data does not really say May through October is terrible. It says the summer window is weaker and more uneven. But not every month in that window is bad. When we group this into seasons, the November to April window completely dominates May to October window in terms of median returns. So the anomaly exists. The summer months are statistically weaker and have higher variance. And this is important because a strategy that sells everything from May through October is not only avoiding these weak months, it's also skipping months that have historically had positive returns. That is the first warning sign. So we just sell on May 1st, right? Wrong. Let me show you what happens to your equity curve if you do. I built a model called Naive Sell in May. The rules are strict. We are 100% long the S&P 500 from November to April. On May 1st, we liquidate and we hold cash, yielding the risk-free rate until Halloween. Here's a 33-year equity curve, and it's not nice. A standard buy and hold strategy delivered an annual compound growth rate of 10.7%. Our naive sell in May strategy, a measly 6.8%. By trying to dodge the summer volatility, you lose out on a lot of compounding. To put that into actual portfolio terms, $1 invested in buy and hold grew to roughly $29 by the end of the test. The naive sell in May strategy grew to only $9. So yes, the strategy reduces downside exposure, but the opportunity cost is massive. Now to be fair, the naive strategy did exactly what it was designed to do. It reduced risk. During the dot-com burst and the great financial crises, sitting in cash during the summer saved you from the worst of the crises. Buy and hold suffered from a massive 55% maximum drawdown. The naive strategy capped its worst drawdown at 34%. Its worst year was also much better. Buy and hold's worst year was around negative 37%, while the naive sell and May strategy's worst year was closer to negative 13%. So, if your only goal is reducing pain, this strategy does have some value. But you're paying a massive premium in lost returns for that safety. You miss the summer rallies, which happen more often than you think. There has to be a better way to filter out the noise. And the heat map makes this obvious. There are plenty of years where May through October was not weak at all. For example, 2025, May, June, July, August, September, and October were all positive. If you had blindly sold in May that year, you would have missed out on an entire summer rally. This is the core problem with simple seasonal rules. They may capture an average tendency, but they don't know the difference between a weak summer and a strong summer. Blindly selling because the calendar page flipped is not an edge. An edge comes from understanding market regimes. What if instead of always selling in May, we only sell when the market's internal mechanisms are actually broken? I built a regime-aware model. Instead of defaulting to cash, this model looks at the trend and volatility on May 1st. Here's the secret. Volatility is mean reverting. Look at the scatter plot mapping VIX on May 1st and the forward 6-month returns. When the VIX is elevated, meaning the market is already panicking in May, forward returns are actually fantastic. Think about May 2020. The COVID crash just happened. The VIX was sitting at 37. If you sold in May, out of fear, you would have missed out on the greatest V-shaped rallies in the history. Forward 63-day returns were near 16%. So our regime aware model sells if S&P 500 is broken below its 200-day moving average, but stays invested if volatility implies a panic bottom is in. This is the difference between superstition and a strategy. Superstition says it's May, so sell. A strategy says it's May, the market is below trend, volatility conditions are unfavorable, and the opportunity cost of reducing exposure is low. The calendar is not a signal by itself. Calendar is just a checkpoint. I also tested May through October volatility targeting strategy. This version does not simply exit the market, instead, it adjusts exposure based on realized volatility, targeting a smoother ride during the weaker seasonal window. Let's look at the final scoreboard. The naive sell and May strategy is a loser. It underperforms buy and hold on absolute return and risk adjusted basis, posting a terrible 0.56 Sharpe ratio. By our regime aware model, it achieves a 0.65 Sharpe ratio, beating buy and holds risk adjusted returns while slashing the maximum drawdown from minus 55% to only 38%. If you want the absolute smoothest equity curve, pure volatility targeting was the winner with a 0.75 Sharpe, keeping drawdowns tight without relying on a calendar. But the important point is, the naive version gives up too much return. The regime aware version gives up much less return while still reducing drawdowns. That's the much more reasonable trade off. And when we look by decade, sell in May helped the most during the 2000s, when the market went through dot-com crash and the financial crises. But the strong bull markets, especially in 1990s, 2010s, and 2020s, blindly sitting out half of the year caused major outperformance. So the strategy is not consistently good or consistently bad. It depends heavily on the market regime. The takeaway: the calendar can highlight historical tendencies, but it cannot replace dynamic regime detection. If someone tells you to blindly sell in May, they're not looking at data, they're just repeating a rhyme. So, should you sell in May and go away? Based on this test, the answer is no. A better framework is to use May as a checkpoint and ask, is the market below 200-day moving average? Is volatility elevated? Is the market in a fragile regime? Are we entering a weaker seasonal window with poor trend conditions? If the answer is yes, reducing exposure may make sense. But if the market is healthy, volatility is controlled, and the trend is strong, blindly going to cash may mean just missing returns. A calendar isn't a trading system on its own. However, when you combine seasonality with filters for trend, volatility, market regimes, it transforms into a powerful risk management tool. If you're interested in the exact code and backtesting framework I use for these models, the GitHub link is in the description. If you also want to run your own analysis and generate custom market insights, you can use the Perspicium platform at no cost. Link in the description as well. If you found this video helpful, please like and subscribe. Let me know in the comments what would you like me to explore next. Thanks for watching, and I'll see you in the next one.